All right, welcome back to another edition of Advanced Accounting. We're going to go through the Chapter 1 notes fairly quickly. I have most of the, if not all of the fillable parts of your files shown on my screen. So take your time as you go through this video. Make sure that everything that is underlined or is blanked out on your file is filled in at some point in time as a means to help you study for the exam. Without further ado, let's begin. Chapter 1 is about investments from a very broad perspective. It's an overview of investments. Most of this is probably already understood. You can review it from your Intermediate 1 lecture notes. I've posted some lecture notes from Intermediate Accounting on Blackboard as well. So as we go through this, if a lot of this looks familiar to you, that's great. If some of this is still fairly new to you, please make sure that you're reading the book and asking me questions so you don't fall behind. There are a couple of things we're going to be looking at in terms of investments. One thing we're going to look at are passive investments. These are the type of investments where a company has some idle cash or excess cash, and basically what it needs to do is it needs to generate some type of interest income or dividends or some type of market returns. That's not too unusual. Most companies have these types of investments. There are also active or strategic investments, and these type of investments are where a company is trying to develop a partnership with another company. Either that or they're trying to take over that company. So we'll look a little bit more into that, but generally think about this. Why would a company like Microsoft buy some sort of small startup company in the Silicon Valley? Could it be possibly because that small startup company has some type of new product or has access to new markets that Microsoft doesn't have access to? That's usually the reason why you start seeing these active investments. They may start off small, but over time they start to build to the point where Microsoft has some form of control over that smaller company. So we'll look more about that later. So when we look at passive investments, one of the things we have to keep in mind are ways we need to classify those investments. So again, you may have seen this before. There are three general categories of passive investments: trading, available for sale, and held to maturity, or HTM. So most companies by far use available for sale as the classification of investments. And the reason why is because it's very non-committal. In fact, sometimes I joke with people about how available for sale securities are kind of like guys who are dating somebody, right? They don't really seem like they want to commit. They're a little bit hesitant. Maybe they're dipping their toe in the water. It's like, come on, dude, make the commitment and go with it. You're lucky to be around her or him or whoever that person is dating. Held to maturity is more like, hey, I'm committed for the long term. We are married. We're going to see this thing all the way through to the end. And I don't mean to scare off anybody from that, but generally speaking, when you fall in love, you want to marry that person. You're in it for the long haul. That marriage, that relationship is held to maturity. Trading is like sort of a booty call, right? You're going around, you're just kind of hooking up with somebody, just having a little romance over the weekend. That's fine. The idea behind trading securities is you don't really see those unless they're at, say, a financial institution. A financial institution being like Goldman Sachs. If they see an investment opportunity, it's probably going to go up in value. Let's go in, buy low, sell high. That's the primary reason why a company would buy these type of securities. They could be bonds or stocks, okay? But if they're undervalued and there's a chance to see an appreciation in value, a company will go in, buy those securities for the short term, sell them around, get the quick gain. Otherwise, if it's a bond and we're thinking, hey, this thing's going to mature in 3 years, let's just hold it all the way through. That's usually a safe investment because, hey, when you're investing in bonds, you're going to be guaranteed the return of the principal as well as any type of interest payments along the way. So held to maturity securities are pretty much just bonds, and they're very safe. Available for sale is by and large the default. Most companies classify their passive investments, debt or equity, stocks or bonds, as available for sale. Now, from available for sale, I usually leave this one last because this is where you leave passive investments and go into more active investments. Available for sale securities, they're just passive. Hey, we have some idle cash. We bought these stocks because they pay dividends. They're a good long-term investment. But the point is that I, as the investor buying Microsoft or Starbucks, I don't have any significant influence over Starbucks or Microsoft. I'm just a small investor just trying to get some dividends or some return on market gains. When I am an equity investor, that is, I own stock, let's say, and I start to see an opportunity for me to maybe control the company somehow, that's where I start to enter into the realm of significant influence. And at that point, I start having to worry about accounting for my stock as if the company, Starbucks or Microsoft, were part of my family, right? I'm not just a passive investor. I'm now in it for, say, the market share, or I'm in it because, hey, I want to take over Microsoft. I will never do that. But if that's my strategy, I'm more of an active investor in that regard, and so my accounting all of a sudden changes. I'm now active, so I either have to use the equity method of accounting or account for a stock acquisition or merger and consolidation as if I actually control the company. And we'll talk about that in a little bit later on. One thing to keep in mind is that most companies, when they invest in some type of stock or bond, they're going to be buying the stock or bond on an open exchange, like the New York Stock Exchange. The reason why is because, hey, perhaps it's a safer bet. Nobody really wants to hang into a stock or bond indefinitely, right? They want to have access to a market to sell it should the need arise. So if a stock or bond is purchased on an exchange, generally speaking, at the end of every day, there's a closing price for the said stock or bond. We can figure out what its fair value is at any point in time. So most companies elect to adjust the value of their investments to fair value based on whatever the closing price is in the markets. So one thing you have to realize is, for instance, that if we have trading or available for sale securities, we can value those mark to market. Mark to market meaning we can adjust it to whatever the closing price is on the exchange. We cannot do that for held to maturity securities because we're not in it for a market gain. We're in it to get interest and get our principal back. So this is primarily the fair value option is for passive investments in trading and available for sale securities. If, for instance, the stock price on a trading security increases, we would generally see that there's an unrealized gain or a paper gain, if you will. Most people tend to overemphasize paper gains. Gains are not gains until you sell the stock at a gain. Unrealized holding gains, they may be valuable to you, but they're subject to change. Realize that if a company chooses to market their investments and the stock price, for instance, of an equity security goes up, yeah, the overall assets on the balance sheet will go up as well as stockholders' equity. But it also works the opposite way. So if a company chooses to market to fair value and the securities, the trading and available for sale securities, they start going down, it's not like you could just put the fair value option on halt until you wait for the market correction. If you want to use a fair value option, you have to market on a regular basis. So to be clear, when we're talking about investments or a company investing in another company, we're talking about passive securities that have no significant influence. No significant influence. It's passive. It's not meant to be a hostile takeover or any of that stuff. In those cases, generally speaking, what companies do is they buy bonds or the common stock that's been issued by the company. And when I say the phrase debt securities or equity securities, that's what I mean. Debt securities, I mean buying bonds. I'm talking about equity securities, I'm talking about buying stock. Generally speaking, the voting stock. We'll ignore preferred stock. We'll talk about put options and put calls and other types of investments, but generally speaking, this is what we want to focus on for the purposes of this chapter. Now, the book gives you a pretty good example, but I think we need to go through it in detail here. So let's assume that we purchase or we acquire the following investments. We have securities A, B, and C. We buy them on this date at this cost. They have a fair value adjustment, and we sell them at certain points in time. So some things to consider. Whenever you're given a problem, take some time to analyze it. Don't just jump into the accounting and reporting or try to answer it right away. Take some time and digest the facts that you have above. Specifically, build a timeline, right? Get a financial overview of the situation, identify events, purchases, sales, etc. Sketch out the transaction using journal entries and ledger postings if it helps you, or sketch out a table, whatever happens, right? Whatever works for you, use it. Down below, what I've done is I'm going to take a look at this series of investments from a trading investments point of view. That is, it's like a booty call. I'm just in it for the quick gains, and then I'm out. If I'm going to hold these things for trading purposes, I have to mark these things to market at the end of every accounting and reporting period. So in this situation, what I've got are the 3 securities. And the way I sort of analyze this is kind of along the timeline as you see here. I say security A, we start at 100, it increases to 125, and then it goes down to 120, and then I sell it. Security B, start at 500, go up to 485, then, go down to 485, yikes, and then go back up to 496. Security C, I only hold it for a quick period of time, turn around, and I sell it. So the way I sort of draw it out here is I like to kind of get an overview from a chronological perspective. I can see that on December 5th, I've already got a realized gain of 14 from when I sold Security C. I can also see that at the end of the year, I have unrealized holding gains of 10, if I just sort of add those items the way down. And then on January 15th, when I sell these things, I recognize an adjustment from period to period of a $6 realized gain. So that kind of gives me some events about the movements and the value. But overall, you can see that there has been $30,000 in gains, in realized gains. Another way to look at this is on a security by security basis. Overall, when you look at security A, you can see I start at 100 and then I end at 120, which means I have an overall gain of 20,000. And with security B, I didn't have so much luck. I lost 4,000. In security C, you can see I have 14,000 as my overall gain. That was a realized gain. If you add those up, it adds up to 30. This gives me a general perspective on the movements, the financial movements. I recommend you draw things out if you can. You don't have to, but it sort of helps keep you, in check as you go through and do this stuff on your own. Now, overall, we can see that the total initial investments in the securities started off at 800,000. If my computer will catch up with me here, starts off at 800,000 and then ends up at 830. Just going to sum up the cost and sum up the sales price. There's an overall sale of 30. I'm kind of summarizing it below. What I see is, from an accounting perspective, I start off with whatever my balances are, assets, liabilities, and equity, and I end up $30,000 higher on both sides. I just need to make sure that whatever journal entries and ledger postings I record actually agree with this. So I'm just going to keep this in mind as I go forward. Okay. Now, when I'm looking at the initial investment, the purchase of trading securities, I prefer to record all my investments in separate T accounts, separate accounts, just so that way I can keep track of them. Keep track of them from a more of an efficient standpoint. Sometimes companies, and they do this in the book, they lump them all into one account. I don't think that's very helpful. So in this case, I'm taking each security. I'm simply saying, hey, I debit investment in trading securities A for 100, investment in trading securities B 500, etc., etc. The overall investment's 800, and then down below, I take all the information and I post it into my ledger. Now, for cash purposes, I'm just going to focus on the change in cash. I know that cash usually has some sort of starting balance. We don't want to have a credit balance in cash. That would imply that we overdrew on our accounts. But in this case, I'm just going to worry about the change in cash. Cash went down 800. That's where we saw that up above the journal entry. The investment A, B, and C, you see I've recorded it there in separate accounts. It's kind of useful, you'll see later, because you'll be able to see, hey, is my investment in A, B, or C making money? If you lumped all these into one account, it's kind of hard to see whether or not your portfolio overall is doing well, right? You don't want to be hanging on to any dogs. Now, moving on, the next event was a sale of Security C. And so what I do in this case is I say I got cash of 214. up above. So debit cash. I love debits. Debits, debits, debits. I'm going to, and I recommend doing this next, record what you know, got cash, then we got rid of the investment trading security C. Its cost basis was 200. We want to look at the general ledger, the ledger account itself, just to verify what the balance is, and you can kind of see right there, hey, there's the 200. So I'm going to get rid of that full amount, and I need to record a credit to get rid of it. So my journal entry is almost done at this point. The final thing you want to figure out is, okay, do I need a debit or a credit as my plug figure in this journal entry? And in this case, you can see, well, I must need a credit of 14. Gains, like revenues, are credits. So in this case, it's a good one. It's a realized gain. And this is a key thing you want to keep in mind here too. This is a realized gain. We sold this, therefore we can recognize in our net income, which affects net income, a gain of $14,000. Now, that's not something to brag about for most companies. Usually these gains, these realized gains, are somewhat small. But in this case, it does affect net income. And so in parentheses, I just make that little note, hey, I want to go to the gain on trading securities account that affects net income. Later, we'll talk about available for sale securities and how they sort of bypass income and show up in a different area of an income statement called other comprehensive income. Let's move on down to the next investment, or the next series of events. So next series of events, it's year end, and we have to mark to market the securities. So in this case, we see that the investment A has increased in value from 100 to 125. Investment B has gone down by 15,000. So in this case, again, I like to sort of record the effects to these accounts separately, not all as one fell swoop. In security A, because investments are assets, assets have a normal debit balance, I want to show a debit, an increase of 25,000 to that account. Whereas in the investment trading securities B, I want to show a reduction of 15. And so down below, you see that I'm doing that in each account. There's the 25 and there's the 15, and it brings the fair value. Now this is fair value to the appropriate amounts, 125 and 485. So that's the journal entry I need. So sometimes when you're going through this, I know typically you're supposed to record the journal entry, then post to the ledger accounts. Sometimes it helps to look at the ledger first and then figure out, hey, what's the plug I need to make my overall balance go up or down to the appropriate fair value. And then all you do is just figure out what the plug number is. You have to kind of look at the journal and the ledger synchronously. That usually helps. Once you do that, you can see that, hey, overall, I need another credit up in the journal entry above. I need another credit of 10,000, and this is going to be a gain on trading securities. But understand this. This is an unrealized. This is an unrealized gain. It's a holding gain. I don't get to necessarily get excited about this until I sell it. But because it's a trading security, the FASB says it's okay to record it in how it affect net income. And I'm thinking, wait a minute, but this is a paper gain. It's unrealized. Why do I show it in net income? And the FASB says if it's a trading security, you're likely going to turn around and sell this thing pretty quickly. That's the whole purpose of investing in trading securities. You're just in it for the short term. So if there's any unrealized gains or losses on trading securities, pop it into the income statement where it affects net income. Fair enough. Down below, I'm going to record gain on trading security, 10. So this looks weird. Bear with me here, though. The 14 we recognized earlier, that was realized. And this 10 down below here is unrealized. And the FASB says that's okay. Throw it all in the income statement. Let the full 24 affect net income. Fine. Trading securities are fairly easy to account for in that regard. There's not a whole lot of messing around you do with the various accounts and reporting in this case. Now, so down below, I take this to the next level, okay? And it's somewhat of a reminder for a lot of you about closing journal entries. At the end of the year, I have to take all my income statement accounts, my temporary accounts, and close them out to zero and get them ready for the start of next year. Closing journal entries looks at the balances in the temporary accounts, such as gains. In this case, I have 24 credit, and it says to make it go to zero, you need to debit that account to make it go to zero. That is what we see up above. There's our debit, gain on trading securities, income 24. Where's the offsetting credit? Well, guess what? It goes into retained earnings. Retained earnings houses all of the revenues, expenses, gains, and losses historically since the beginning of time, since the time that this company opened up. So in that regard, whatever retained earnings is, I'm looking at changes in retained earnings here. I'm going to increase with a credit retained earnings by 24. Generally speaking, that's a good thing. Revenues and gains, they're all credits. They all end up in retained earnings. Now, when you look at the net effect on the balance sheet here on the asset side, credit 586, debit 125, debit 485. The net debit we see on the asset side is 24. Well, guess what? We see a net credit of 24 on the stockholders' equity side. So the balance sheet is balancing. We've done everything correctly at this point. But you have to make sure you are familiar with and understand the concept of closing journal entries. If something affects the income statement, you also have to worry about its simultaneous effect on equity, be it through retained earnings or accumulated other comprehensive income. We're almost done with this sucker. Let's take a look now at the January 15th event here. We sold the securities for a total of $616. So we got rid of them. We got cash. Cash makes me happy. Debits make me happy. Debit cash 616. Incidentally, that's how I learned debits and credits. I always kind of anchored on cash. I knew when getting cash, I got cash. Getting cash was good, and I had to debit cash. So I always got a little smiley face, going on whenever I debited cash. That's how you memorize debits and credits. Cool. It's how I learned debits and credits. I got cash. That makes me feel good. I'm emptying out my investments in A and B. So the way I sort of look at this is say, let me look at the ledger and see what account balances I need to empty. So these guys, I know I need to get rid of whatever balances are in the ledger. Let me take a look at the ledger really quick. And I can see investments A, I currently have a $125,000 debit balance there. Investment B, I have a 485 debit balance. How do I get rid of those? I've just sold these things. I got to credit those accounts away. And so that's what you see up here. That's how I determine what amounts I'm crediting. Credit securities A and B, make them go to zero. Once I do that, I'm practically done. My last item is a plug figure. In this case, it's 6. What is it? It's a credit, so it must be a gain. And in this case, if FASB says, hey, you sold the securities, so those are that's true income, that sucker is most definitely realized. Okay, so down below, there's my 6 on the income statement right there. And as a final step, what do I have to remember? Closing journal entries. I have currently a $6,000 credit balance in my gain in securities. I need to debit that away to start my next year fresh. That makes it go to zero. So there's my debit right there in the journal entry. Every debit needs a credit, or so we're told. So where's the credit go? It must go to retained earnings. That's where all of these income statement accounts end up, is retained earnings. So there's the credit down below there. There's my credit journal entry there. And when we get down to the bottom, you can see I've cleaned out all my investment accounts. I have a net change, a net increase in cash of 30, not a bad little investment. Net debit of 30. On the equity side, you can see my retained earnings has increased by 30, just like in our analysis, or analysis, right? Which is the whole reason why we did the analysis, just to make sure that if we've done everything right, the balances should make sense at the end. So hopefully this makes sense to you as I've gone through this. Hopefully most of you find this as a refresher. Hopefully it's intuitive. I don't like to make it more complicated than that, but I felt that it's necessary to kind of get more detailed information than just simply what the book showed you. Now I want to look at the same example, but talk about it from the perspective of available for sale. What is the difference between an available for sale security and a trading security? These are going to be the same actual investments, but we're going to classify them differently. So we're going from trading classification to available for sale. Okay, how does available for sale differ from trading? Well, first, it differs in how we present the unrealized gains and losses on the income statement. So down below, I'm kind of giving you sort of a glimpse into what we're about to see. In trading securities, we show the effects of gains and losses, regardless if they're realized or unrealized. We show them up above the net income line item. We show this as other gains, other losses, other revenues, other expenses. They're kind of down below in the income statement. But the key thing here is that any gains and losses that are trading securities affects net income. But if we have any type of comprehensive income, that is changes in our equity accounts that don't really have anything to do with performance during the year, we have to create a separate section of the income statement called the statement of comprehensive income. And if you need a review of that, check out the PowerPoint slides that I put up on Blackboard. Now, the way the statement of comprehensive income works is it takes the balance in net income as a starting point. And it says from there, what happened? Well, we had some unrealized gains or unrealized losses that are not necessarily reportable as part of income. They do exist, they did happen, but we don't want to show them affecting earnings or earnings per share. So we stick them below net income and comprehensive income. Can you comprehend what I'm saying here? We can actually have unrealized gains that don't show up in net income. We bypass net income, put this in this other comprehensive income section. And when we do that, essentially we keep our net income clean. We don't dirty it up with any unrealized gains or losses from available for sale securities. Now, I know that seems weird because just a second ago I told you that unrealized gains and losses from trading securities does affect net income, but if they're available for sale, unrealized gains and losses don't affect net income. I swear to God, there's going to be a change in this rule at some point in time. This cannot be that much of a deal here. So this is the one nuance that you have to pay attention to. Let's look down below at the next nuance. When we are, and by the way, I like to use the word nuance a lot. When we close out our revenues, expenses, gains, and losses on the income statement, where do those things go? Into the retained earnings account that we talked about before. Well, what about any type of line items that are comprehensive income in nature? Well, we have to close those out, not to retain earnings, but we create a separate equity account called accumulated other comprehensive income. It's like a retained earnings account, but it's there just to temporarily kind of buffer things that are in limbo. So imagine, you've probably seen a lot of ghost stories where people die and now they're wallowing around in limbo. I mean, I think this harkens back all the way to the old Christmas Carol movie, right? Ghosts of Christmas Past, whatever, right? Don't end up like me, right? So you, in between going from the real world to the heaven or hell, there's this limbo stage, right? Well, you're not quite sure what to do with these other comprehensive income gains and losses, so they're in limbo. What do we do once these things become realized? Oh, you're going to hate this. We have to reverse them out. We don't directly change this account. We don't directly change AOCI. What we have to do instead is record some type of what's going to be called a reclassification. A reclassification basically says there's something in AOCI that we have to reclassify and recognize up in retained earnings. But we can't do it on the balance sheet. No, that would be too simple. What the FASB says we need to do is show a reclassification somewhere in OCI in an offsetting realized gain or loss up in the income statement. So we're kind of like shifting it up into the income statement. And when we do that, all right, so what we're going to do here is we're going to show a reclassified, for instance, gain at the bottom. And then we're going to show an actual gain up at the top. And by doing that, if we have a gain, we'll get rid of it from AOCI when we close the account. The reclassified account will close out or empty out AOCI, and then we'll stick it up into retained earnings where it belongs. This sounds more complicated than it is. We're going to look at some examples here. All right, so everything you see on the next series of slides is what we've already walked through. So I don't want to spend too much time wallowing in this area. You're going to know what to expect. The only real difference I would say is instead of debiting and crediting investment in trading securities, we're debiting and investing investments in AFS. So these account titles change. That's pretty much the only difference that you see. Everything else looks the same. When I actually sell a security, an AFS security, if it's a realized gain, I'm just going to put it into income. Those are realized gains. They will go and hit the income statement, just as we saw before. Keep going down and down. This is where it gets a little bit weird. Instead of crediting a gain on AFS securities that affects income, we're going to credit gain on available for sale securities that affects other comprehensive income. This is the primary difference in these examples. It's an available for sale, it's unrealized. Therefore, we don't let it affect net income. We stick it down into a bypassed account called OCI. So the 14 from the realized gain, that shows up on the income statement and affects net income. Below net income on the income statement in the OCI area, that's where we'll show the other portion, the 10. That's the unrealized gain. So we're keeping these things separate, but notice how the accounts are still marked to market. We still see fair value adjustments showing up in the accounts themselves. And by the way, as a side note, does it make sense to use, say, a separate T account for these adjustments in fair value? We can do that if we want to. I don't want to clutter up our notes any more than is. So any type of fair value adjustments, I say screw it, just put it inside the account itself. Now that we're there, we have these two different temporary accounts. How does the closing process work? It's somewhat similar to what you've seen, but in this case, we have to look at our income statement accounts and our OCI accounts and close those out into separate accounts on the balance sheet. The gain on available for sale securities that shows up on the income statement above net income, that still gets closed out into retained earnings. But the $10, or the $10,000 in this case, that's in OCI, we don't show that in net income. That's just considered other income, other comprehensive income, and that sucker gets put into its own equity account called AOCI. They both show up in the statement of stockholders' equity. They're still equity accounts. Overall stockholders' equity will increase by the full 24, reflecting an increase in the assets for the full 24. Nothing from a broad perspective is really different or manipulative here. But from an accounting perspective, we are saying specifically those are AFS securities and those are unrealized gains. we need to put those into AOCI. And that's what we're doing here. AOCI is essentially the accumulation of any type of OCI on the income statement. That's why it's called AOCI. It's just temporary for us. All right, so I want to revisit this balance sheet income statement comparison between trading and available for sale securities here. Recall that from the trading securities point of view, any type of gains, whether realized or unrealized, we're going to go above the net income line item, therefore show up in net income, and therefore show up in retained earnings. Trading securities are simple that way, but available for sale, we had to separate out that which was realized from that which was unrealized. The realized portion that affects net income goes into retained earnings. The unrealized portion doesn't. It goes into this limbo state called accumulated other comprehensive income. It's not there for us to use, pay out as dividends. So yes, we do have holding gains of paper gains of $10,000, but we can't really say, even though it affects equity, that those are part of our earnings. And that's the whole point of using OCI in this case. Trading, much easier. Now down below, let's take a look at the sale of the securities. As we saw before, we generated cash of $616,000, and we had to get rid of or empty out our available for sale balances in the trading, in the securities A and securities B. We need to get rid of those. But how do we do that when we've got this limbo state part in our accumulated other comprehensive income? You see down below where we have this 25 gain, unrealized gain, and this 15,000 unrealized loss. Those were just unrealized. Now we can say that we've sold these, so we can look at that and say, let's actually recognize these, but not directly. What we're going to do is say, look, let's reverse out in the AFS investments. Let's reverse out any unrealized gains or losses in those accounts. Get rid of them. Reverse it back to whatever the cost basis was. If we do that, we can see that in this case we have a net credit of 10 over here. We need a debit of 10 under what's called a reclassification of gains on available for sale securities. Up above in the journal entry, that's where you see it. Reclassification of gains available for sale securities. It's not a gain, it's not a loss, it's a notification that, hey, we have these gains that are stuck in limbo in AOCI. And the FASB does not like us directly messing around with the AOCI account. We have to leave that alone. If we're going to make changes to retained earnings or AOCI, for control reasons, we're going to use the income statement. So we have this debit reclassification of gain AOCI, which will eventually end up removing that $10 from AOCI, but not yet. When we put that 10 in the journal entry up above, we're missing something else. We still need another credit, and this credit is going to be gain on available for sale securities. Oh, hello. Gain on available for sale. It doesn't like me doing that. Gain on available for sale securities. And this is going to show up in my income statement. And that's going to be 416. That's the plug figure. So down below, we're going to show 16. Now think about this for a second. Okay? We knew at the end of the prior period that there was 10,000 unrealized in gains. And we know that by the end, from the trading securities example above, the journal entry had another credit of 6 as a realized gain. So when you look at this, I've essentially, in available for sale securities, I've deferred the realization of the $10,000 until I fully, completely disposed of the AFS securities. Yes, there was a $10,000 unrealized gain. No, I cannot realize that in my net income. Yes, I can defer realization until future periods when I actually sell the thing, which is what you and I as investors should really be doing. Even though we have paper gains, we shouldn't get excited. We shouldn't consider ourselves rich just because we have paper gains. We should look at those as just temporary fluctuations in our comprehensive income. When we sell securities, reverse out any of those unrealized gains or losses, realize them up above in income. So that's what we're doing here. Finally, I get rid of the overall amounts. There's the 100, excuse me, if I look at this kind of line by line here. Debit cash for 616, get rid of the $100 cost basis, $500 cost basis. It means I have a $16,000 gain here. I got 616. I got rid of an investment of 100,000. Got rid of an investment of 500,000. I must have a $16,000 realized gain in this case. That's what's going on. So I separate this posting into a couple different line items to sort of show you what's going on here. But at the end of the day, keep it, if it's too complex, keep it simple for yourself. You knew there was cash of 616 when we sold it. We had to empty out the AFS accounts. The tricky part is if there's any AOCI that's lingering around, get rid of it through reclassification of gains. Then you have a plug figure that's going to be your overall gain or loss for that sale. All right, one final little bit. We were done with the sale journal entry. Now what I want to do is, I think this is a small little typo here. Let me clear this up so you don't get confused. Now what we're doing is we are going to do the closing journal entries. So let me zoom in here. Closing journal entries 12/31/20 or 2019 in this case. So closing journal entries, what do? We look at what's in the income statement accounts. We have a 16 credit in our gain on available for sale securities. We have a $10 debit on the reclassification. What are we going to do? Reverse those things out to get them to zero. So up above the gain on securities, the debit of 16, the credit reclassification, getting rid of those. Where do those things go? Well, if it's income related, it's going to affect retained earnings down below. So that's where we see the credit up above. If it's OCI related, it's going to affect AOCI, and this is the key feature. We could not, in good conscience, directly remove AOCI when we sold the securities. We had to go about using the income statement accounts. Seems tedious, it was for control reasons, but when we do that, we see that we clear out AOCI, thanks AOCI for being a good buffer, and we finally recognize the full $16,000 gain in retained earnings. The effect of doing that, we can see down below. Overall, we got $30,000 increase in cash. Yay! Securities are gone. Securities are gone. Overall, we see we have an increase in our equity for 30. And guess what? All that increase is now inside retained earnings. It only shows up in retained when it's an available for sale security. It only shows up in retained earnings when we've sold the securities. Okay? If we haven't sold them, we push them off into AOCI. Once they're sold, take them out of AOCI, put them in retained earnings. That's essentially what's going on. There's just a lot of these journal entries and buckets we have to play with to do this stuff. So, a couple more things we want to talk about here with regard to AFS securities. Impairment testing. Okay, if there's a decline in value, generally speaking, these declines are marked temporary market declines. Yeah, if you recall in the situation of securities B, it was kind of a dog. right? It went down by 15. We didn't really like that too much, okay? But if we looked at that and said, hey, it's just a temporary fluctuation in the market, it'll probably recover. It's okay for us to put the loss into OCI. And it's also okay to directly reduce the investment in the security itself. So down below, I've sort of taken this a short portion of the journal entries we previously looked at and recorded it as you see here. Okay, that's typically what we do when we have temporary declines in our AFS securities. Is that decline in value an impairment? Most people say it is an impairment. As long as fair value is below cost, the thing is impaired. However, be careful when you say the word impairment. Impairment is sort of a buzzword, a very negative buzzword. Okay, impairments usually mean a decline in value that's not recoverable. If this is a temporary decline because, hey, the economy just sucks right now, fine. Just record the loss to OCI, record a reduction to the investment account. However, given that's just for market fluctuations, what if the decline is not because of market fluctuations? What if we look at the decline and we say, you know what, we better get out of this security. In fact, we better sell this right away because we want to get our cash now. If we think we can't hold on to this thing long enough for it to recover, then what the FASB says is do not simply record the loss to OCI. Record a loss to income directly, because you may still hold this thing, but you plan to sell it. And right now it's a dog with fleas. You better report that $15,000 reduction in value as essentially an impairment, a loss, a real loss that affects your net income. Then credit the investment available for sale securities as we've done before. Okay? So don't pass O, don't collect $200, go right to jail. Okay? That $15,000 decline, you're going to realize that within the next 15 days when you sell the sucker. Put it right into income. That's where it belongs. Okay? Down below, there's a third thing we have to consider with regard to reductions in value. If we see that there's a reduction in the value on the market and we do some research and we find that the company that issued the bonds is having some performance difficulties, okay? It may mean that, for instance, they have to file for bankruptcy or something like that. That's bad news, right? So if the situation involves credit losses, a loss in the trustworthiness of our investor, or excuse me, of the investee, then we have to look at that decline of 15 as a real effect to income. And rather than reduce the investment account directly, we're going to use an allowance account that acts like a contra account. So in this case, yeah, we're still not going to use OCI. We're going to directly put it into income, have it affect income, but we're going to bypass the investment account and just set up a contra offsetting account, the allowance for credit losses. The overall fair value is still shown down below when you net those two together, but we're just keeping those separate because why? The reason for the decline is something other than a temporary market fluctuation. I'm going to skip over the held to maturity investments. This is something that you've probably seen before in your intermediate class, and I think the book does a pretty good job sort of explaining it. The only thing I would add on to when it comes to bonds that are held to maturity is I recommend that you get comfortable sketching out a chart, an amortization chart. In this example they gave us in the book, the company bought securities at a discount. The principal or the face value is $1 million, but it was bought at a discount of $965. So there is going to be some $220,000 about $234,000 extra income that comes from this investment. but we don't recognize the full amount over time. Rather, we have to amortize that amount from the day we bought it to the day that it matures. So not 200,000, excuse me. What am I talking about? About 30,000, 34,000, whatever. Is it material? No, not to the poor people like me. So in this case, the company bought it at a discount. When you buy things at a discount, you have to understand that the true interest that you recognize, in this case, it's an investment. So it's generating for us interest revenue. We're going to get cash receipts from the thing based on stated rates. But the market rate, which has a higher yield, is actually telling us, look, we're going to recognize more revenue than what we actually get in cash. And why do we do that? Why are we recognizing extra $7,000, $8,000? Well, that is part of the difference between what we paid for it and what we're going to get back at the end when it matures. So in this example, what they go through here is they kind of go back and say, look, recall how you do amortization schedules. You take the difference between your interest revenue and your actual cash receipt of interest, and that determines your amortization. That's just going to go directly into your investments in held-to-maturity securities. We could set up a separate valuation account for our discounts and premiums. In this case, it's just easier to net our discounts and premiums in the investment account. So if you have questions about that, by all means ask me, but I think this one's pretty straightforward, so I don't want to belabor the point. And I've kind of highlighted all the different effects, the necessary journal entries here. When we move away from passive investments, we get into this area of significant influence. And significant influence does not mean control. Significant influence is basically that in-between place where we're no longer passively just collecting dividends and interest. We actually have a seat on the board. We have the ability to affect financial policies, and perhaps we can conduct some transactions between us and the investee, right? Maybe they were our competitor before, but once we buy 30-40% of their outstanding stock, yeah, they have to, they have to play nice with us. So perhaps we have this kind of like 40% stake in this investee where we can start doing business with each other. But that doesn't necessarily mean that we're going to get certain cuts or breaks in the pricing. We might get cheaper pricing if we buy stuff from this investee, and we might reduce the pricing of goods and services to the investee if we sell. Downward and upward sales, we'll talk more about those in Chapter 6, but realize there are some synergies that can occur if we develop a significant stake in these investees. Generally speaking, we're talking about owning 20 to 50% of the outstanding voting stock of the subsidiary in this case. Once we do that, we look at these, as an investee, but also somewhat of a subsidiary. They're part of the family now. And there's a little bit more different accounting that we have to do when we have this significant influence, which we illustrate below. Recall that when we looked at available for sale securities and trading securities, we use a T account called investment in, we just said investment in ... whatever the security was. Okay, we're still going to use a T account called the investment in, but we're not going to, the accounting is going to be a little bit more complex because in this case, under equity method accounting, we have to treat this investee as family. They're not necessarily like so close to us like a spouse, but they're kind of like a distant cousin. And so whenever good happens to them, we get some benefit ourselves. Whenever bad things happen to them, we feel kind of bad, right? Now, if you're married or ever plan on being married, generally speaking, when your spouse is suffering or is in pain, you feel that to a full extent. That's usually because in the eyes of the law, you're viewed as one entity, you and your spouse. If we're talking about a distant cousin, you might get together once a year. exchange stories, but whatever happens to them doesn't affect you as much. So that's what we're kind of talking about, is like distant cousins. We still record a debit for the cost of the investment. But here's the beautiful thing about the equity method. If our investee has net income, we get to record some of it in our financial statements. We didn't do anything. All the work was done by the investee, the subsidiary. But if they do well, we do well, which is kind of like cheating. Some people call it double counting to some extent, but that's okay in the eyes of the FASB. Essentially what we'll do is we'll up the investment account and we'll get to record as income a portion of their net income in our net income. It's beautiful. But the bad thing is the opposite's true. If the subsidiary does crappy, we're going to do crappy as well. The downside, the other downside I would say about the equity method of accounting is usually when we get dividends from these investments, they're a good thing. We debit cash, we credit dividend revenue. But because we're practically family, dividends that we receive, we debit cash, we actually have to reduce our investment in that subsidiary. Because why? Because dividends are viewed as a return of our investment. Their equity goes down when they pay dividends, therefore our investment in them goes down. If the company, the subsidiary has a net loss, the subsidiary's equity goes down, our investment goes down. If the subsidiary has net income, their equity goes up, our investment in that subsidiary goes up. So we're kind of like mirroring whatever the subsidiary is doing through the equity investment. Okay, that's why we call the equity method. Whatever happens to the equity of the subsidiary affects our investment in that company. And we're going to look at some examples down below here. All right, for those of you who don't know my examples that I use in class and on exams, the main character in my accounting stories is Beerbo Inc. Okay, that's the focus of most of the examples. Every other entity is some outside entity. So in this example, assume that we are Beerbo and we acquire 30% of Dudmeiser Company, or DMC, outstanding stock, 300,000 shares. We pay $12 million. The book value of DMC approximates its fair value. You don't really see that. Usually when you look at a company's market value of equity, it far exceeds their book value of equity. Okay, but in this case, let's keep it simple. During 2019, DMC reports net income of $2 million. Okay, remember, if the subsidiary does well, we do well. The subsidiary also declares dividends of 50 cents a share. We still get the cash, but it's a return on investment. So down below, what I do is I sort of talk about an analysis. Before you do anything, you really should go through this exercise and think, what's going on here? If I have 300,000 shares, and that 300,000 shares represents 30% stake in the company, that means the total outstanding stock of DMC is 1 million shares. That's interesting information. I might use it later. I don't know. Another piece of information is we can figure out that DMC's overall book value is $40 million. In other words, their total equity is $40 million. Or if we looked at assets minus liabilities, we would see that that would net to $40 million. Interesting information. How did I come up with the $40 million? The $40 million is the book value of the company. I determined that because, well, first, I knew that the fair value approximated the book value. And if the book value represents the book value that I bought multiplied by times 30% equals 12 million, I can rearrange the equation to say, look, 12 million divided by 30% equals 40 million. In other words, I took a 30% chunk in the equity of the business. Let me sort of talk about what that looks like here. I kind of did a little drawing here. Let me see if I can sort of find it here for you here. If a company, the 70% of a company I don't own is represented by that yellow box. And then I've got the stake that I bought down below, the 30. 12 million is what I paid. And that represents 30% of whatever this is up here. That's 100%. Okay? So this dollar amount times 30% gets me 12 million. Reverse the equation. What's $12 million divided by 30%? Look at that sucker, 40 million. Let me zoom in so you can see it a little bit better here. 40 million. So 40 million represents the full amount, 100%, whereas 30% of that is $12 million. That looks like that makes sense. That means the amount of book value and fair value that I don't own, that's owned by other shareholders, is the difference. Interesting information. It's just good to know that. Now going back here, that's how I came up with that little equation down there. Interesting to know, this is just part of the analysis. I strongly recommend that you all start practicing critical thinking in this regard. Look at the whole transition holistically. You have bits and pieces of information. Why not fill in the rest? You might need it later. DMC grew by $2 million. That is, their overall equity increased by $2 million. How did it do that? Well, it had net income of $2 million. Net income increases retained earnings, which increases equity. So the overall book value or equity of DMC increased by $2 million. Hey, guess what? I have a 30% stake in that, which means that my investment in DMC must have also grown by $600,000 or 30% of $2 million. I'm mirroring to some extent what the subsidiary is doing. Also, DMC paid $500,000 in dividends. How did I figure that out? Well, from up above, I knew that there's 1 million shares outstanding, and 50 cents a share was paid out to shareholders. Good thing I'm a 30% stakeholder, because that means I'm going to get cash of $150,000. Bad news is dividends reduce retained earnings, which reduce equity, i.e. book value. So I've kind of got two things going on. I got an increase of $600,000. That's the earnings of the subsidiary. But then there's a reduction in their equity due to the dividends, $150,000. So net, I'm still in a pretty good position. $450,000 net increase overall. Not too bad. Down below, you'll see the journal entries. My initial investment, $12 million. My initial investment in Dudmeiser, $12 million. Cash paid $12 million. There you see it down below. 12 million, 12 million. I put a little BV next to the 12 million down in the ledger because I'm going to start keeping track of what goes inside this T account. It's going to get really messy here over time. The next thing I want to do is say, hey, I got $600,000 to recognize due to the net income recognized by DMC. So that sucker is going to increase my investment account. Again, whatever happens to the subsidiary, I mirror to the extent of my investment, 30%. They do well, I do well. I'm not double counting, okay? I'm just reflecting how the fair value in my investment has changed due to the performance of the subsidiary. Where do I recognize the credit? Well, this is the beautiful thing. I can show it in this account called equity in DMC earnings. Or another phrase we can call it is equity in the income of DMC. Regardless of how you want to call it, get used to this name. Equity in whatever earnings or income. That net income that they show on their books, I get to show on my books as well, but only to the extent of 30%. It seems like cheating, but it's not. All right, I have $12 million staked in the company, so it's all good on my end. I'm going to get those cash dividends, love those debits. Recognize that. What do I credit? I'm going to reduce the investment in DMC down below. Why? Because it's a return of capital. They're paying me back. This isn't a reward necessarily. This isn't necessarily a reward of my investment. Usually dividends are some type of thank you for investing and taking the risk. Here, we're practically family. So imagine my cousin cutting me a check. They won the lottery. Say they won like $10 million in the lottery. My cousin writes me a check for $50,000. Doesn't seem like a lot of money relative to how much, but you think about the taxes and everything too. Taxes. Ugh. But let's say my cousin, my distant cousin, he won $1 million. Hey, you know what? He loves me. We're distant cousins, but he'll still throw a few bucks my way. Here's $50,000. Thanks, bro. But did he really give me money? It's debatable, right? It's kind of like, well, technically we're all family, right? So if someone dies, there's some type of an estate inheritance thing that goes on, right? So you have to look at this thing about dividends differently now. We're family. It's kind of just shifting money from one hand to the next, not from one person necessarily to the next for family. That's the equity method in a nutshell. And we're going to do a lot more examples later on. So make sure you know this method really well. Now let's look at the same example, but let's change the facts up a little bit here, okay? The biggest thing I'm going to do is say, look, Beerbo is now paying $15 million for a 30% stake in DMC, okay? Now, why is Beerbo doing that? Well, it turns out that the book value truly is $40 million. In other words, if we look at total assets of $90 million, subtract off $50 million total liabilities, the total equity, book value of equity is $40 million. Book value equity is the same thing. Write this down. Equity equals net book value of the company, which equals assets minus liabilities. Okay, that's the equity of the business. Now, we knew that from the previous example. We figured that out. Now we're given more detail about it. Interesting. Why do we need to know more about these different assets? Well, it turns out that when we look at the assets of DMC, it turns out that they have some unreported technology that they could patent or sell on the open market for like $5 million. Interesting. Now this technology has maybe a 5-year remaining life, and everyone else will kind of figure it out, and then it'll be basically, freeware, open software, let's say. But the other thing that DMC has going on is they have some specialized equipment, plant and equipment that is undervalued by $1 million. That's not unusual. Companies report their equipment, their vehicles at depreciable cost. We don't show appreciation in land. We don't show appreciation in equipment or vehicles. All that stuff goes down in value. So it's not unusual to say, hey, look, you got some specialized equipment here that actually is, probably some value on the market above what you see on the books. And we also acknowledge that there's a 10-year remaining life on those things. All right, fair enough. What does that mean overall? A lot of different numbers, okay? Here's what I sort of recommend you do. First and foremost, let's take a look at this chart down below. Overall price paid was $15 million. Why did we pay $15 million? Well, here's part of it, okay? The book value, we're getting a 30% stake in the book value of the company, the equity. You multiply that out, that means we have a $12 million stake in their equity. We're also saying that there is fair value bumps, fair value adjustments. Part of it has to do with their, these are right. Yeah, so revaluation of plant and equipment, 30% times $1 million, $300,000. Unreported technology, 30% times $5 million, $1.5 million. So in the negotiation table, I might sit down with the shareholders and the board of DMC and say, hey, look, let's do this deal. And they may turn around and say, yeah, we're not going to take $12 million from you. That's a starting point. And I might be like, what? Are you trying to rip me off? And they can turn around and say, look, we have these fair value adjustments that aren't even reported on our balance sheet. You should compensate us for that, pay for that. You're going to invest 30% in our business. Acknowledge that there's these unreported assets that require fair value adjustments. And I might turn around and say, fine, I'll pay an extra $1.8 million. And then they might turn around and say, up, hold on. We still want more on top of that. And I might look at the board and say, what? You're trying to rip me off? Say, look, we have some shareholders that are going to be pretty pissed off if we just organize this deal. I mean, there's some employees that are worried about losing their job if you come in and gobble up a huge chunk of our business. So let's grease the wheels a little bit more. Throw an extra $1.2 million on top of your investment. And why do you do that? Because you want to instill between us and the investee goodwill. We want there to be goodwill between us. We don't want to feel like this is a hostile takeover, or we're trying to, get rid of people's jobs or take over their pensions, right? We're going to sweeten the deal. Okay, throw an extra $1.2 million, everyone's going to be happy. Okay, that's the idea behind goodwill. I'll pay a little bit extra above fair market value. So what this means is, from an overall perspective, is that companies have their accounting books, their balance sheet. Their balance sheet shows book value, i.e. equity, okay, in this case, it was $40 million. And then we said there's some fair value adjustments in the upward direction that total another $6 million. And then on top of that, we say, look, if we were really to go out, if we were to look at the market value of equity, if we look at stock price times number of shares outstanding, perhaps there's another amount that we would want to add on top and say that's another $4 million right there. So we can look at the fair value of the company or the fair value of DMC as a whole and say that they're worth $50 million. That's not what you see. This extra stuff is not in the balance sheet. Okay, that's where the analysis comes into play, and that's where you start to really make the big bucks, is when you're able to sift through the obvious details and start asking the critical questions. Are these assets and liabilities truly what they appear to be in the balance sheet, or do they have a fair value that's higher or lower? On top of that, what are some other things, some intangibles, let's say, like intellectual property? Maybe that has some value too. We haven't considered that, right? Lots of things determine overall value. Now, I'm going to give you that information for the sake of this class, but you really need to think broader outside the scope of just the obvious debits and credits to determine what real value is. So down below, here's what I've done. I'm doing the same journal entry we saw before, only in this case, it's not 12 million. It's actually 15 million. Was 12 million. Okay, so now we're up to 15 million. Otherwise, it's the same investment in Dudmeiser Company for cash. And down below, you can see I've broken this thing out in more detail. I've got the book value, 12 million. There's the fair value adjustments for the technology, the fair value adjustment for plant and equipment, and the extra the 1.2 million for goodwill. That equals the 15 million in cash I paid. Generally speaking, all you see is just an overall $15 million debit to this account up above. Okay, but for my purposes, for analysis and for accounting, I like to sort of show more detail in the T account. So I do it this way. I recommend you do it as well. Assume that the net income is still 2 million, dividends are still 500,000. You got your journal entries below, just as we looked at. Okay. Now, here's the tricky part. What we've introduced in this example are adjustments in fair value due to the technology and as well as the fair value bump associated with plant and equipment. The tricky thing about this is we have to amortize these things, these bumps, these fair value adjustments away because they have a finite life. We don't amortize, for financial accounting purposes, goodwill. We'll leave that in the investment account. But over time, we need to whittle down this 1.5 million and 300,000. We need to whittle that down away to nothing. And so that's what we're going to look at next. So how do I do that? Well, recall, let me back this up here, that the 1.5 million fair value technology, that had, I believe, a 5-year life, right? So that's $300,000. I just checked on my calculator. I could have done it in my head, but trust but verify. So every year, what we want to do is amortize $300,000 of that 1.5 million away because it has a finite life. We do that for 5 years. That whole portion in the T account will go away. The $300,000, we're going to divide that by 10 years. That's going to be $30,000 per year amortization. So the total amount that we want to reduce the investment account each year is $330,000. That gets rid of the fair value adjustments, the amount of extra we paid for these fair value assets. One of the reasons why we do that is because DMC has depreciation and amortization on its tangible and intangible assets on its books. It's taking care of all that stuff. We don't have to do the accounting on Dudmeister's books. They're doing that. But any depreciation or amortization that is outside of their realm, outside of their expertise, we have to do that. So in a lot of ways, what you see here is we're taking care of amortization expense that is not the responsibility of DMC. It's our responsibility. We created it simply by investing in this company. We're not going to reduce any specific asset account other than the investment in Dudmeister. We're not going to debit an expense account like amortization expense. Rather, we're going to use these expenses, if you will, to offset what we show in the equity in DMC's earnings. So down below, what you see is there is the credit of $330,000. Essentially, I'm amortizing away those fair value adjustments. They'll be gone after 10 years in total. The expense, if you will, is not really an expense. It's just an offset to whatever equity or net income portion we recorded. So these expenses are sort of just offsetting our equity in DMC's earnings. Remember, that's that net income, that $2.9 million. So in a lot of ways, we can look at this and say, hey, during the year, yes, there were dividends paid. Yes, there were fair value amortization amounts. But overall, the net income, the portion I recorded, the 30%, is higher. So my overall investment is doing well. I see an overall improvement in my investment of $270,000 net of any dividends that were paid back to me. So yes, I may have paid, right, $15 million in this case. Excuse me. Computer's getting a little weird here. So yes, I initially paid $15 million. And it's gone up to $15,120,000. I've seen an increase of $120,000 in my investment in 1 year. Not too bad when you think about it. I mean, I'm taking a pretty significant risk. What is that $120,000 comprised of? Well, it's essentially this $270,000 in net equity in their equity in DMC earnings minus the $150 in dividends. So $270 net earnings minus $150 in dividends. That's where this overall 120 comes from. So as long as this thing is increasing over time, and I know that the amortization of the 330 is going to go away, I can consider this a pretty good investment so long as DMC keeps turning out, good earnings year after year. All right, last little bit of the book, we're going to talk about control. There's going to be more discussion about control and the accounting for control in future chapters, so this is a good introduction here. Generally speaking, when we're talking about control, we're talking about mergers and acquisitions and consolidations. Come on, computer. Stay with me. Okay, so the merger is by and large the best form of control because the effect of doing that is we get rid of the target. The subsidiary, the investee, it goes away. Bye-bye. We take all of their assets and we bring them onto our books. Take all their liabilities, bring it onto our books. It's a pretty straightforward journal entry. So down below, I give you information where Beerbo pays $40 million to acquire 100% of DMC. And down below, I give you information about what the fair values are of the various asset and liability accounts. We are only concerned about fair value. We're paying for this, and when we pay for anything, just like a cup of coffee, we're paying fair value. Okay? So in this case, the fair value of the current assets, plant equipment, technology, net of the current liabilities, when you look at all these together, you see that these sum up to $36 million. Okay? Now, why would I pay more than the $36 million? I mean, these are the fair value. This is the fair value of the net assets of the company. Why would I pay an extra $4 million? Because I want there to be goodwill between us, right? This isn't a hostile takeover, right? I want to make everybody happy, so I'll throw another $4 million on the pot. There's the $40 million. What do I do next? Record the journal entry, and it looks pretty simple and straightforward because it is. All of these accounts that we bring on board, for instance, we are recording these at fair value. Their current assets are credited. We debit our current assets. So think about it like this. Cash is a current asset. Whatever cash they had on their books, it's now ours. I just bought you. Thank you. Give me your cash. Whatever equipment you had, thank you. Now that's mine, right? So we offload all of their assets and liabilities, and we bring them onto our books. So essentially, it's just this giant balance sheet gross up. Their entity goes away, ours gets bigger. There's the cash we paid, and then down below you can see, hey, net, there's $50 million in liabilities now that we have, and $50 million in assets. This is what's called a balance sheet gross up. Okay. Usually when you're doing an analysis of a transaction, you want to keep in mind what the overall effect is, especially if you're on the audit side of things. Going down below, when we look at stock acquisitions, this one is a little bit different because when we're doing a stock acquisition, we're saying that we want the stock to legally still exist. But that means that the company still legally exists. So in other words, what we can do is instead of buying up all of the assets and liabilities of the company or buying up all of the stock and dissolving the company, what we can do is we can say, let's buy up 100% of the voting stock, but let's keep the company going legally. It still exists as a separate legal entity. Now you will see down the road why the accounting for this absolutely sucks. Because over time, you have to keep track of what the initial investment is, what each year's net income is, what each year's dividends are, what each year's amortization of fair value adjustments are, plus you have to worry about any type of upstream sale and downstream sale between the two companies. It's just a headache. So when you see this whole consolidation or stock acquisition, you really just a tear should be dripping down your face, like, oh gosh, the pain. But then keep in mind too, that's why we get paid the big bucks. So let me sort of show you what happens here from a day one perspective. Stock acquisition. Now, we pay $40 million for all of DMC stock. The company still exists. It doesn't die. It's still going on. So they're sitting there like, hey, we're still here. And we're like, good for you. What's the journal entry we do? It's this. That's it. We debit an investment account. We don't debit current assets, plant and equipment, technology. We don't credit current assets. The comparison is staggering here. When we're doing a merger, as you saw up above, a merger had a really large, a ginormous journal entry, right? Look at all these things we have to debit and credit. It's a pain in the neck. But the cool thing about mergers is the company is dissolved, and we only have to do this once. When we do a stock acquisition, we do a simple journal entry initially, but we have to do consolidation reporting at the end of each year, meaning that we have to look at their balance sheet, their income statement, and add over everything they have in each one of their accounts every single time we issue our financial statement. It's a pain in the butt. The initial journal entry is simple, but don't let that fool you. That's not the candy you want, okay? Excuse me. Down below, I sort of break out those different accounts too, because over time what you're going to see is if we have several years of accounting for this thing, we have to keep track, I recommend at least keeping track of all the individual movements, all the income, all the dividends, all the amortization, etc. I recommend you break these things out in the T account and keep track of them. It will just help your sanity down the road. But that's the journal entry. It looks simple and straightforward, and you'll see in the chapters ahead that it's really not. So I'll holler back to you. Let me know if you have any questions.